Hello and welcome to this fourth episode of Investing Not Rocket Science. In the first episode, I defined a basic portfolio framework. In the second episode, I evaluated the US megacaps, Apple, Amazon, Google, and Microsoft. And post that evaluation, I decided to add Google to my portfolio. In the third episode, I looked at engineering and automation stocks. And of the stocks that I evaluated, I considered Emerson. I shortlisted Emerson. And today, in this episode, we're going to continue looking at engineering and automation stocks. So Emerson Electric and Siemens from the last episode, and I'm going to compare that with ABB, Schneider Electric, and Rockwell Automation. Although initially I had put Siemens on the watch list, but the revenue market cap multiple of Siemens is quite attractive, and being one of the larger stocks in the engineering and automation sector, I decided to bring in Siemens as well, just to make sure that I haven't missed anything out in my life. Company financials. When we consider company financials, I can see that Siemens has a great revenue market cap multiple. However, when I look at net income to shareholders, then Emerson is ahead. Now, that is not to say that this will not change at any point in time in the future, but at this point in time, in this particular evaluation, in terms of net income, Emerson is the attractive stock among all of these companies. In terms of unlevered free cash flow, again, Emerson has about 3.9 billion of unlevered free cash flow in the last 12 months. Compare that to 5.2 billion for Siemens, but with a much lower revenue. Schneider Electric is pretty good in generating unlevered free cash flow as well. Okay. Debt to equity, I see no concerns. Rockwell has about 150% debt to equity. Emerson is at par. It has the capital structure is for debt and equity is the same. Schneider Electric and ABB has comparatively lower debt on their books. Price earnings ratio, again, Emerson is the least expensive stock today, and Rockwell and Siemens are the most expensive at 32, approximately 32 price earnings ratio. Emerson also has a volatility of 27%. So all of these stocks have a volatility anywhere between 26 to 37%. So the real question is that am I willing to look at a loss of 27% in the next 1 year? And if I can, then this is a stock that I could look at. Revenue growth, let's look at some trends in the financials. You see Schneider Electric and Emerson are the two stocks that have growth, which is revenue growth, which is trending upwards. The other three have downward trending revenue growth. So until that were to change, ideally, I would not consider them at this point in time in the portfolio. In terms of operating income margin, Emerson is right on top at 18.3%, followed by Rockwell at about 17.5%. Okay, and pretty flat. There's no real concern in the operating income margin. Inventory, I see Siemens has the largest inventory considering its size. This is not a surprise. They're pretty flat for all companies. Siemens has a slightly rising trend in the inventory. Capital expenditure, again, no major surprises. Stocks are either flat or trending lower in capital expenditure. Okay, interest expense. Um, Again, the companies with the least amount of debt. So Siemens has the highest interest expense, and this is only going to continue rising in a rising interest rate scenario. So this is something to watch out for. At this point in time, I could consider stocks which are ideally have lesser debt on their books. Okay, unlevered free cash flow. Um, Schneider Electric leads the way with about 9 billion, and Siemens at about 4.6, and Emerson at about 3 billion, and 1 billion for ABB, and about 636 million for Rockwell. So Emerson has been pretty consistent in their unlevered free cash flow. The trend is rising slightly, so that's a good sign as well for this stock. Okay, fair value. I looked at two options for fair value. Again, I'm using Investing Pro to generate these values. So the discounted dividend method and the discounted cash flow method. In both cases, I've also looked at what is the potential upside to that fair value. Emerson's the only stock at the moment that offers upside on both methods, while ABB offers an upside on the cash flow method, and the same with Schneider Electric as well. Both Rockwell and Siemens appear to be trading above their fair value currently. Now, I understand that this is based on certain projections of the future performance of the company, and also there is no reason why a stock should or has to trade in and around its fair value. It could be very likely that the stock would continue rising, as in the case of Siemens, which has had a pretty good run, and move further and further away from its fair value and probably top out at a point where fair value then catches up with the stock price. That could also be possible. However, in terms of an evaluation and comparing various stocks in the same sector, this is I think, in my opinion, this is a fair way to understand if I'm picking up a stock which is undervalued currently, which is what I'm looking to do. All right, in terms of its chart, Emerson is looks like it's in a rising trend since 2008, although it's at the top. Well, towards the top end of that range. So there could be that there is, if the market turns negative, then this stock could fall to the middle of this range around 80 or 79, maybe even lower, depending on how deep the market could fall. However, at this point in time, Emerson is an attractive stock. It generates the kind of cash flow on a consistent basis and delivers net income to its shareholders, and it has comparatively reasonable debt on its book. So, my portfolio action is going to be to buy Emerson Electric and to put Schneider, ABB, Rockwell, and Siemens on the watch list. There are other companies in this sector, such as Honeywell and Japanese firms like Fanuc and Mitsubishi Electric. These are stocks that I would like to consider at a later point in time. I'm going to circle back to them later. In the next video, I'm going to evaluate semiconductor stocks in the IT space, and I'm going to look at adding maybe one or two stocks from the semiconductor space into my portfolio. This is Investing Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. We can connect on LinkedIn. Please do go through the disclaimers and terms of use on our website. And thank you very much for watching. And I look forward to seeing you in the next video.